Hi everybody, Tarek Morshed with the Morshed Group at Sotheby's, here to share with you stats and a market update of what's happened in Q1 in Austin residential real estate. It's been certainly a very interesting and challenging quarter, starting in Q2. Q1 actually was a very healthy and robust quarter in our real estate market. We saw about a 3 to 4% appreciation rate leading into the end of March. And that was primarily being driven by job growth, as we predicted last year in Q4's market update, wherein we were expecting 35 to 40,000 jobs being created this year and really driving our market to some strong appreciation. So that 3 to 4% in Q1 extrapolated over a full year would have been a 12% appreciation rate. So really strong start out of the gate, and very on pace with what we had thought was going to happen based on our job growth. And supplies were extremely low, supplies meaning inventory of housing. We were at 2 months supply. As you've probably heard me share before, 6 months supply is where you have an equilibrium market. Anything below 6 months supply is starting to be undersupplied. At 6 months, we typically get a 4 to 6% appreciation rate. Above 6 months, you might even see depreciation, but below 6 months, you're going to get even stronger appreciation than 4%. Hence, we saw the 3 to 4% just in Q1. So that was our start, and really truly all the price bands, 0 to 500, 500 to million, above a million, million to 2, 2 to 3, 3 to 4, were all undersupplied and below 6 months with really, really robust activity. Then of course, COVID hit around mid-March. And even though Q1 finished very strong, because a lot of folks were already under contract in March, and therefore we did see some terminations in the marketplace, certainly, but there just have been so much under contract that Q1 was going to end really well. So that's kind of, that brings us up to kind of where we are or where we were at the end of March. And what I want to actually espouse on a little bit is what happened in those last 2 weeks of March, because here in Austin, we went into shutdown right around March 15th. And what happened right around March 15th is we literally in the marketplace saw about a 50% de-engagement by buyers, right? So the market was really strong, really robust, and all of a sudden about 50% of buyers and even sellers hit the pause button of moving forward in real estate until they figured out what was going to go on or what was going to happen. And that has continued through April, so it's kind of transition into where we are at right now and where I see things going out of all this. Through those last 2 weeks of March and then through April, as I said, we saw about a 50% pullback in the market. Interestingly enough, supply of housing has not moved up throughout April. We're about 2.5 months. We're at 2 months at the end of March. Prices have held really steady, actually. And then negotiability has been minimal. And it just hasn't been, 5, 10, 15%. Now, we're not seeing as many multiple offers, and we're not seeing, things move as quickly, but you're also not seeing a huge spike in inventory or supply or negotiability or pricing moving down. And the question would be why? And there's several ways I'd answer that. One is job growth is our main driver here in our real estate market. And the fact of the matter is we happen to be in a lot of industries in Austin where it's going to hold up better in a time where job attrition is happening across the country. So for example, over 40% of our workforce here can work remotely and or do work remotely, which is a huge number. Also, the unemployment rate in March, where in most cities around the country had already moved up to 8, 10% or higher, we went from 2.5%, which was already one of the lowest in the country, to about 3.8 months. And at 3.8 months, even in a good economy, most cities would be jumping up and down about that. So we didn't have a lot of attrition throughout March as well as so far in April. Not that there hasn't been some pain around that, but it hasn't been terrible, and therefore that's going to show up in the real estate market. Where supply isn't going to zoom up and prices aren't going to zoom down, and negotiability is not going to really open up until that supply number starts really moving up closer to 6 months or beyond. The other thing is that real estate, unlike the stock market and equities market, tends to be much more localized. While the stock market can have these huge swings, as it did in March and April, where it dropped 30% and then recaptured about 15% so far in April, the real estate market is much more latent in how it shows up. And then number two, because the local drivers impact each local market at such a high level, that ends up having a huge impact, and maybe even more so than what's going on national and global. And I don't want to underscore or understate what's happening nationally and globally. It'll definitely impact our real estate market, but you can understand where if our job market is holding up a lot better and a lot of people aren't losing jobs compared to other places, well then the real estate market will probably hold up better here. So that's kind of the other reason why, between that and unemployment, between the job attrition, the types of industries we're in, and so on, and then real estate markets being much more localized than the stock market, you can kind of see the combination of why the market hasn't moved down a ton. Looking ahead and what I expect, I believe, and even what's happened in April, is around April 15th in the real estate market, we were allowed to start showing homes again. And what that did was it created an automatic 10% bump of people re-engaging. So now we're at about 60% of where we were in the beginning of the year in terms of buyer activity. And what I expect to see happening moving forward is, until we're out of quarantine, it's not going to get better than that. I believe we're hopefully going to be out of quarantine by the end of May or so. And I think our supply will creep over the next few months as employment does creep up, in my opinion, up to somewhere around 6 to 8% locally in Austin. Might get to 10%, but I doubt it. And because of that, then we're going to see some more homes in the market, maybe less homes selling because buyers are still not fully re-engaged. But I think that supply will creep up to somewhere between 4 to 6 months from 2 months currently. But at the same time, buyers are going to start re-engaging once we're out of quarantine. And so over the next few months, I expect the engagement to be at about 70% of what it was in the beginning of this year. In doing so, what will happen is we'll move forward into the year, and I think that we will see that jump to about 80% of people, maybe 75% of people that were engaged in the beginning of the year, re-engaged by the end of the year in the market. So I do think that about 20 to 25% of the buyers are not going to come back this year in the marketplace. However, because we were at a 2-month supply and we were so undersupplied, our market can truly absorb that. It's the same reason why we haven't seen price drops happening yet and supply is not moving up much. But even when we move up to 4 to 5 months supply over the next few months, typically price drops and depreciation don't happen until after the 6-month supply number. We'd have to get to a 7 or 8 month supply. And I think by the time we're getting there, we're out of quarantine and we're starting to slowly rehire and everything's starting to get back to normal, although it probably doesn't get back to more than 80% of what it was. So I expect to see it all play out in a manner where we probably don't see much appreciation, if any, the rest of the year, but we probably don't see a ton of depreciation. At worst, maybe 3 to 5%. I'm expecting it to just really kind of be flat for the rest of the year. I do expect, like I said, supply to move up some over the next few months, but then also float back down throughout the year. And I don't think we'll end up as low as 2 month supply. We'll probably end up at about 4 to 5 month supply or somewhere around there. And then we'll kind of be set for the next year and getting back to what I thought we would have this year, around 7 to 10% appreciation. So I hope all this made sense. I know that was a lot of detail and data. Please reach out to us if you have specific questions about your area or your sector. Obviously, that makes a huge difference. And we're here to certainly help you, serve you any way we can. And I look forward to sharing more as we cull and iterate the data that is coming to us. Also be looking for us via social media, because we are also going to do some updates about every 2 weeks as we get some iterative and fluid data. So instead of just doing our quarterly market update, this next quarter we'll do a few more to keep everyone apprised. Thank you so much again, and look forward to being with you soon.